the previous class, we discussed about the liquidity premium theory and the market segmentation theory. What we have seen that in the market segmentation theory, the market is highly segmented and the demand and supply forces of the market is confined to that particular segment only. There is a different supply side supply sources for the short term bonds, and there are different type of investors who demand the short term bonds. The same thing also can be prevailed in the long term bond market. So, therefore, there is a difference between the long term bond and the short term bond, or the return we get it from the long term bond is different from the return from the short term bond. But one thing you remember that that market segmentation theory tells that there is some kind of independent relationship exists between the long term bond and the short term bond rates. But in the practical sense, does it really happen, or is there any possibility this long term investor can move into the short term bond market and the short term bond investors can move into the long term bond market? So, those kind of scenarios also can be established or can be built up. So, assuming those kind of arguments, those kind of justifications, another theory was established, that is called the preferred habitat theory. What this preferred habitat theory basically explains? The preferred habitat theory basically assumes investors and borrowers are willing to give up their desired maturity segment and assume the market risk if the rates are attractive. Remember, if the rates are attractive, what does it mean? They know that there is a risk involved by moving from one segment to another segment, because it does not fulfill their investment philosophy or investment horizon period, their requirement, but still they are ready to move if their risk is fully compensated or adequately compensated. That means, there is some kind of spillover can be possible, and when it will be possible, whenever one segment investors will be rightly or adequately compensated by the different returns what they are expecting to get whenever they are moving from one segment to another segment. So, in that context, what this theory basically assumes, that investors and borrowers will be induced to forego their perfect hedge and shift out their preferred maturity segment when supply and demand conditions in different maturity markets do not match. When it is possible? It is possible whenever there is a demand supply disequilibrium in one segment. If there is a demand and supply disequilibrium, it will affect the yield. So, obviously, if the supply is more, demand is not there, then the yield will go down. If demand is there, but supply is not there, then the yield will go up. So, in that context, what will happen, that they will find that whatever expectations they have, whatever return they are expecting in that particular segment, and that return is not being realized because of the demand supply inequality, then what will happen? They will be ready to move if other segment is doing well in that particular point of time. Obviously, this investor can sacrifice their preferred segment in that particular point of time. In the beginning, we discussed about the segmentation part, but even if there is a segmentation, still the investors will be ready to move from one segment to another segment whenever they feel that there is some kind of disequilibrium exists in terms of the demand and supply in that particular segment where they are operating. So, because of that, what basically they will do, they can move from one segment to another segment. So, that is what that means, that is not a perfect hedge which is existing in that segment. So, therefore, they will be prefer to go to another segment and that particular point of time. So, so that is why we can call it that the preferred habitat theory is a necessary extension of the market segmentation theory. So, if an economy is poorly hedged, that means more investor want short term investments and more borrowers want to borrow the long term. Obviously, it is not hedged perfectly. then the market will not be in the equilibrium. That just now what I was explaining or I was discussing with you, that whenever the economy is poorly, if the economy is poorly hedged, what does it mean? More investors want short term investments, but the supplier, basically the borrower, want to borrow the long term. So, in that case what is happened? There is a disequilibrium which can exist between them. So, if there is a disequilibrium, the interest rate which can be prevailed in that particular point of time, this is not a equilibrium interest rate which can be prevailed. So, in such cases what generally happens, the short term and long term rates will change and the market can be cleared as investors and borrowers give up their hedge. They basically will not be interested to stay in that particular segment and they will give up their asset liability matching concept, matching principle, and they can move from one segment to another segment. This is what can be possible whenever this market is in the disequilibrium. That is what basically can be observed. So, here if you see how basically it exactly happens. If you see this example, in the long term market, the excess supply would force the issuer to lower the bond prices. Why? Because obviously what will happen, that if there is excess supply, but the demand is not there, then what will happen? Then obviously it will reduce the bond prices. That is why it is increasing the yield. The price goes down, the yield will go up, which induce some investors to change their short term investment demands. You see, if the yield is more in the long term bond market, then obviously the short term investors or the market, if you assume that the segmentation part, then who the investor who are there in the short term segment, they will be attracted by the return what the long term bond market is giving. So, why they will stick to that short term bond market? They will be ready to move from short term bond market to long term bond market. In otherwise, another condition if you see, in the short term market, the excess demand would cause bond prices to increase and the yield to fall or rate to fall. Then what will happen? That kind of scenario, it will induce some of the companies to finance their long term assets by selling the short term claims, short term securities, whatever they have. So, the reverse can be possible. That means, here what here in overall we are trying to say, if there is some kind of disequilibrium which happens in one of the segments and another segment is more attractive in that particular point of time, both investors and suppliers will be ready to move from one segment to another segment, because the yield is attractive in that particular segment, or it is profitable for them to take their positions in that segment instead of sticking to the segment wherever they are already now. This is what basically the preferred habitat theory is trying to say. So, ultimately what will happen? The equilibriums in both markets should be reached with long term rates higher than the short term rates, and a premium necessary to compensate investors and borrower or issuers for the market risk they have assumed or they have taken. So, if there is a movement, then what will happen? Obviously, there is a disequilibrium makes the movement, and once the movement takes place, over a period of time, this equilibrium can be established and market can take care of to come back to that equilibrium point, because there is the mismatch which was created before, that mismatch will be withdrawn and this mismatch will be overcome, and obviously, the equilibrium can be established within that particular segment. Then how it is basically explained? It can be explained in this way. If you see, this is the explanation what basically we can give. This is a short term bond market, and this is a long term bond market, and here this is your yield curve. What is happening? This is your supply of the short term bond, this is your demand for the long term bond, this is basically your original equilibrium, right. So, for example, now the if you see the supply is more in that, then what is happening? Demand is not there. So, in that particular point of time, so here if you go back whatever in the assumption we have taken, that the interest rate, the supply is more, demand is not there, then what is happening, that the interest rate has gone down here, the price of the bond basically increases. In that particular point of time, what basically happening, there is a movement to the long term bond. So, in this case what basically we have seen, the interest rate which was there in this level, the interest rate has gone up to that level. So, here the demand has increased, supply is there. So, because of that the return will be higher. So, now the interest rate, new interest rate or the yield will be more. So, now the yield will be more in this particular segment. So, finally, if you bring this back, this is basically your yield curve which can be drawn. So, what is the explanation we can give in this context, that the bond demand in each segment is assumed to depend directly on its own segment's rate and the rate in the other segment. Bond supply in each segment is assumed to depend inversely on its own rate and the rate on the other segment. That is the general notion of the or the relationship between the supply and demand with the yield. Whenever if you see that, if you go back to our previous slide, what basically we have seen that whenever there is a excess supply, the excess supply would force the issuer to lower their bond prices. Excess supply will lower the bond prices, thus increasing the bond yield. So, here what basically we are trying to say, if you see in this diagram also, what here we are trying to show, there is a excess supply in the long term bond market. The excess supply in the long term bond market has increased the risk, has increased the rate. So, in that particular point of time, what has happened in the short term bond market? The short term bond market, if you see what assumption basically we have taken, in the short term excess demand, the excess demand basically has reduced this interest rate. Here there is excess supply, here there is excess demand. So, in this part we have excess supply, here in this part we have the excess supply, here we have in this excess demand. So, therefore, the interest rate has gone up in this segment and here the interest rate has gone down. So, then there is a movement from this to this, because the yield is very attractive in this segment. So, here then obviously what will happen, that again this two in the two different markets, whenever there is a movement, this demand will increase, then once the demand will increase, then it will compensate with the supply, then finally what will happen, this equilibrium can be established, a new equilibrium can be established in this segment. Here whenever this supply is the demand is basically more, now supply is not there and more people move into that, then obviously what will happen, that the demand supply equality also can be established and equilibrium can be established in this segment. So, in this context both the market will be in equilibrium, and finally, what you can do, that you can draw your yield curve. This is what basically we try to explain and the preferred habitat theory is trying to show. So, here if you can summarize in this way, the excess supply in the long term market would force the issuer to lower their bond prices, increasing the long term bond yield, and excess demand in the short term market would cause the short term bond prices to increase and the yields to fall. So, then how it is basically explained, you see in this context, that is investor prefer the short term bond. So, that is why the excess demand in the short term bond market, which increases the price of the bond, then the yield will go down, and this particular attracts the long term borrowers. Obviously, if the rate of interest is very low, this will attract the long term borrowers. More people wants to borrow the money from that particular market. So, here the borrowers basically prefer the long term bond, here the investor, here it is the borrower. Then excess supply in the long term market, then the price of the bond goes down. If the price of the bond goes down, the yield will go up. If the yield will go up, then this attracts more investors. So, here this market will attract more borrower because the interest rate is very low, and this market will attract more investors. So, obviously, here there was a excess demand. Now, the supplier will be there in that particular segment. Investor on average prefer the short term investments, then corporate issuer borrowers on average prefer to borrow the long term and sell this long term corporate bonds into that particular segment. So, therefore, the equilibrium can be established in two different segments, and the spilling over from one segment to another segment can take place. This is what basically the overall theme of the preferred habitat theory, where they can basically assume that there is a kind of disequilibrium in the different market segments, which were basically argued by the market segmentation theory, can cause some kind of movement from one segment to another segment because of disequilibrium or between the demand and supply within that segment affects the yield, and once the yield is attractive in another segment, this movement can take place. So, this is what the preferred habitat theory is trying to explain. So, this is what basically this the basic notion of the different theories which are existing or which are arguing about the determination of term structure interest rate in the markets. Then if you see that other thing is, if you summarize that a long term bond yields increase and short term yields decrease, and some investor would change their short term investment demands or preference, increase their demand for higher yielding long term bonds. That means, movement down the long term bond demand curve and decreasing their demand for the lower yielding short term bonds. So, movement up to the short term demand curve. The decrease in short term rates and increase in the long term rates would induce some corporations, some companies to finance their long term assets by selling the short term claims. This will lead to a substitution in which the companies would increase their sale of the lower yielding short term bonds and decrease their sale on the higher yielding long term bonds. So, this is the conclusion what we can draw from the preferred habitat theory. So, here what we are trying to see. So, this in this kind of scenario, there is a shift, or this shifting can take place from one segment to another segment, and as well as the interest rate may not be perfectly hedged, or their risk may not be perfectly hedged within that particular segment. Therefore, it will have the impact upon the interest rate or the yield, and finally, what will happen, the movement can make the equilibrium in both the markets, and finally, accordingly the business units make their policy or strategies. By that, they can minimize the risk, and as well as the interest rate of that particular system can be determined. Then if you see that apart from these all these theories, in general sense, whenever we talk about the term structure interest rate, why there is a differences. For example, there are some of the factors which are very general factors, common factors. If anybody wants to specify econometric model, that why this how the term structure interest rate is determined, what are those factors which makes the differences between the long term and short term bonds, then in that context we have to specify a model, and that model is basically derived on the basis of certain common or general factors which affect the interest rate differential between these two types of bonds. What are those? You know that whenever you talk about the models, basically what we see, your econometric model is basically defined in this way: normal regression model, your y is equal to let alpha plus beta x plus u. So, here your y is equal to your dependent variable, x is equal to your independent variable, beta is the slope or the coefficient, alpha is the intercept. So, here I have shown you that one single independent variable equation, but it can be also the multiple variable equation, that if you see that if you want to write that why there is a long difference between the long term and short term interest rate, or we can say that the long term rate, a long term interest rate is a function of certain variables, like we can write in the econometric way that long term rate is equal to alpha plus beta 1 let x 1 plus beta 2 x 2 plus beta 3 x t x 3 and so on, plus beta n x n plus u, which is error term. So, here in this case what are those x 1, x 2, x 3 and x n. So, we have to determine, theoretically we have to assume what are those possible factors which can determine the short term and long term interest rate differentials. So, this thing whenever you talk about, obviously there are many factors which affect this. The first factor which comes to our mind, that is the current and expected inflation. Current inflation, already current purchasing power determines that what kind of inflation risk exists in the market. Accordingly, this interest rate in the market also gets changed. Already you know that your Fisher equation, already we have explained that, and this is nothing but the nominal rate, nominal interest rate is equal to the real interest rate plus inflation, right, that already we know, or nominal interest rate minus inflation is equal to real rate. That is the equation what we have seen. And another one is the expected inflation. Then obviously, if the inflation risk is going to be more, then the interest rate also is going to be more. Then how it basically works? So, what do you mean by the expected inflation? I can give you idea that expected inflation also can be measured. So, the practical measurement of expected inflation is, you can measure this 3 years moving average, 3 years moving average of actual inflation rate can be a proxy for expected inflation. This is the popular measure, unless you can measure also through this quantitative theory of money equation, m v is equal to p t, m is equal to your money supply, v is equal to velocity, p is equal to your inflation which is price level, t is equal to transaction demand for money, then p is equal to m b by t. You can have the money supply data, you have the velocity data, it is more or less constant for a particular period, you have the transaction demand for money, through that also the expected inflation can be calculated. So, here what is the argument, that if the expected inflation will be higher, then the interest rate also will be higher. Then you have the transaction cost. Then obviously, whenever you are using the transaction cost argument, there are two arguments always works in this. Some people argue that because the transaction cost is lower for the long term maturity bond, because once you have taken the position, you do not have to change the position for a large period of time or the longer period of time, then because the number of transactions will be low, because of that the rate should be low. But other argument is that the transaction cost tend to increase with the length of time maturity, because the greater risk of long term securities to dealers who make the market. Because whenever anybody invest in the market, or the stock broker, any kind of broker or dealer who basically invest on behalf of you, they take also more risk whenever they invest in the long term bonds than the short term bonds. So, therefore, the transaction cost may be more for the long term bonds than the short term bonds. So, that is why there are different counter arguments in that. So, keeping those everything in the mind, expecting that the long term bonds are more riskier than the short term bonds, we should expect that the return from the long term bond also should be higher than the short term bonds. So, then in that particular point of time, if you read the yield curve can give you the answer if whether the yield curve is downward sloping or upward sloping, that will give you the answer whether which particular argument is more valid in that particular context, whether the transaction cost argument is valid in for first argument or the second argument. That means, the transaction cost is low for investment in the long term bond, or the transaction cost is high for the investment in the long term bond. That is basically the another thing what we can observe. Then we have another factors, we have default risk. What do we mean by the default risk? The default risk is basically the possibility of the failure to meet the terms of loan arguments of delay in payment, of total non-payment, or the partial non-payment of interest and the principal amount. What is the probability that the money which has been should be paid is not paid at that particular point of time? That means, for example, if the bank has given the loan, what is the probability that the borrower is not able to repay the loan? So, that is basically we call the default risk, or in our language also we call it the credit risk. And then obviously, if somebody has invested in the long term bond, then bond issuer should pay the periodical coupons to them and finally, the principal. But what is the probability that the issuer will pay this particular coupon and principal over the period of time regularly? So, obviously, for long term bond, the probability of repayment is there, probability of non-payment is there. So, because of that, the credit risk is also will be high. So, if the credit risk will be expecting that credit risk will be high, then the investor always demands that more yield from that type of bond. So, therefore, the long term bond should give more yield, more return than the short term bond. That is why default risk is one of the major factor. Then you have the call risk. What do you mean by the call risk? Some of the bonds have the call feature. So, call feature means whenever the bond was issued, at that particular point of time it was mentioned after a certain period the issuer can call back the bond at a particular price, but the investor does not know when the bond will be called once the threshold limit is over. So, because of that what is happening, they feel that at that particular point of time if the interest rate is very low and if the bond will be basically called back by them, then whatever thing basically they are going to get, that may not from the bond issuer, that may not be sufficient enough to compensate the risk what they are going to face. Because whatever proceedings they will find, the value they will find, at that particular point of time the reinvestment in the market will be costlier for them, or they may not get very high return in that particular point of time. So, because of that they expect that the interest rate for the bonds having call risk should be higher. Then another most important factor is marketability. So, the security which is easily marketable can always earn lower return than the security which is relatively less marketable. Marketable means that liquidity, whether the bond is easily traded in the market or there is a demand for that particular bond in the market or not. If the marketability is high, then the return will be high. If the marketability will be low, then the return will be low. So, these are the inflation, then you have the default risk, you have the call risk, you have the liquidity risk, you have the transaction cost. These are the major factors which basically determine the term structure interest rate theory in the practical sense, and the which makes the differentiation between the interest rate what we expect from a long term bond and a short term bond. This is all about the different arguments or different concepts related to term structure theories of interest rate. Please go through this particular references for this particular session. Thank you very much.